Bonds has always been seen as a safer, less exciting cousin of stocks. However, in recent years, we have seen a number of high-profile bond defaults for retail bonds such as SWIBOR and HIFLUX. This brings us to an important question. Is bond investing safe or risky? And are bonds simple or complex products? To answer these questions, Dollars and Cents is at the SIAS Fixed Income Conference 2019, and joining us today is Christopher Tan, CEO of Providend and Executive Director of MoneyOwl. Christopher is also one of the speakers at the conference, where he discussed about how he can use fixed income in his portfolio. So Chris, thank you for joining us today.
You.
Okay, so my first question is, many investors opt for bonds because they consider it a safer instrument to invest in. However, in recent years, we have seen a couple of high-profile bond defaults, and so this brings us to an important question. Are bonds safe or risky?
We always say that bonds are a lot safer as compared to equities, but really it all depends on what kind of bonds, and there are different kind of bonds and also different issuers that issue all these bonds.
It seems that bonds are not as simple as what many people think they are. Are they actually very complex?
I think on its own, bonds as an asset class is actually really simple. Sometimes it is even simpler than equities, right? I mean, bonds in its purest form is really an IOU, right? I lend money to a company or I lend money to a government. In exchange for that, I get an interest, and in bond language, we call it coupons.
Yeah.
Usually, the coupons are paid semi-annually. Yeah, and at the end of the term of that loan that you lend to the company, you should get your capital back. It's as simple as that. But it's when we start to add things into it, we try to repackage it, that it becomes sometimes a bit more complex.
So how do you think our bond investments should be made so that it complements our existing stock portfolio, our existing investment portfolio?
Yeah, so I think we have to understand that if we want to use bonds, they are really meant for two main purposes. Yeah, the first is for retiree to generate an income stream. That is where bonds are useful, because a bond instrument gives out income.
Fixed income.
Fixed income. If you are an accumulator, and by that I mean someone whom you are still young, you are in your 20s or 30s, you are trying to grow your wealth so that you will have enough for an objective like, for example, retirement or funding your children's education, I would say that a better instrument to use would be equities, because it is equities that is going to give you that reward for the risk that you take. But the problem with investing just in equities is that, well, some people just cannot take the ups and downs of the market. As much as they know that they need to stay invested for the long term, and the longer they stay invested, the volatility actually reduces. But it's a head knowledge. The heart can't understand this. And so, if you can't take it, it is better to add bonds into your portfolio.
Okay. I like what you say earlier on, which is that bonds are safer compared to stock, but that's for a given specific company. So I'd just like to touch on one question, which is that, since the idea of investing in bonds is to enjoy diversification, if we are already investing in the stock of a company, should we still then be investing in its bonds?
Well, I think it all depends on the issue, and you brought a very good point. Yeah, I mean, I can be buying stocks of a very good company, a blue chip company, and then I buy a high yield bond of a company that might not have that track record, right? Now, from an asset class perspective, it's a bond and equity, and it seems like the bond is safer, but it's not true, right? Because you're buying a high yield bond and the default risk is very high as opposed to an equity of a very safe company, right? So we can't just look at it in that way.
I think this is a question that many people also have in mind. Would you consider our CPF saving as part of our bonds or fixed income portfolio, since most of us Singaporeans already have a significant amount of CPF savings for our retirement?
Yeah, I don't really look at our CPF as a bond. As I mentioned earlier, the purpose of bond is to hold up the portfolio such that when your equities are going down, hopefully because of the negative correlation between bonds and equities, it stabilizes the portfolio. The thing about CPF is that there is no capital appreciation. Right? It is not traded in the secondary market, right? But I will look at our CPF as a good safety net. If you are planning for your retirement, your CPF is going to give you an income stream when you reach 65 years old, regardless of what happened to your stock investment.
Or what happens in the financial market.
That's right. Yeah. So I will look at my CPF as the portion of money that gives me a safe, reliable income stream. such that my other portfolios, which might include equities and bonds even, as they fluctuate, I'm not dependent on it for my income so much. I can hold on to it. I don't want to sell it if I don't want to sell it, because I have my CPF that gives me a safe, reliable income stream. Yeah, but looking at using CPF like a bond to stabilize the portfolio, well, it doesn't really play that role.
Okay, I just want to talk about the Singapore Savings Bond, and I know that it doesn't function as a regular bond simply because you don't trade it on the exchange, you know. But it does provide that liquidity solution where, you know, if I want to redeem my bonds, you know, within 1 month, I can get my money back. Do you think that's a good option for especially for first-time bond investors or people who have never invested in fixed income before?
You know, our Singapore Savings Bond, or SSB in short, is a very interesting instrument because it's really not a bond. Yeah, it doesn't have the feature of a bond at all. Firstly, there's no price appreciation. Secondly, it cannot be traded. Thirdly, the coupon is not even fixed. Every year it changes, right? It goes up generally, right? So the Singapore Savings Bond is really not a bond. It is the government's saving instrument. And how it works is that basically you pay, say, $500 to buy this Singapore Savings Bond. At the end of 10 years, the Singapore government guarantees that you will get your capital back. And even if you need to redeem it any point in time, 6 months after you buy and you change your mind, you want to redeem it, you always get the capital back. This is so different from a bond, which the price may fluctuate. And I would say, don't look at the Singapore Savings Bond as a bond component of your portfolio. Use the Singapore Savings Bond as a place whereby you can park your emergency fund.
Okay, good point. So I think I just want to touch upon how a newbie or first-time bond investors can really get themselves some bond exposure. You know, there's corporate bonds that you can invest in. There's also bond ETFs. You know, what are your thoughts about maybe investing in a bond ETF? Particularly because sometimes it's not so easy for retail investors to get access to some of these corporate bonds just because of the quantum that's required. Will bond ETF be a good place to start?
I would say a better place to start would be to invest in a bond ETFs. Another option is that there are funds, very few of them, but there are funds that actually do not just invest in many bonds, but they choose those bonds that give a higher expected return, not through market timing, not through getting where the interest rates are going. So I think those options are better because you are really mitigating company-specific risk. You are still buying those bonds. The only thing that is different from buying straight bonds is you don't get a coupon payout because the coupons are reinvested. But if you are an accumulator, it's fine because you're not buying a bond for income. You're really buying a bond for stabilizing your portfolio.
Okay, great advice. Okay, we've come to the end of our discussion with Christopher today about bonds. But if you have any question that you wish to ask us, feel free to drop us a comment on our Facebook or YouTube page wherever you're watching it. And a final word of advice, always remember that all forms of investment, including bonds, comes with its own set of risks. So always aim to be a more knowledgeable investor so that you can make the right investment decisions that fit your risk profile. Thank you.